In response to the coronavirus global pandemic, Congress has passed a $2 trillion stimulus package in order to help ease the economic effects that this virus has and will cause. In this podcast, not only will we cover what was in the act, but also how it impacts you and your financial plan. Hello, this is Andrew Busa, and I'm a financial planner here at Advisor Investments. We're here with another Advisor You Can Talk to podcast. And today I'm joined by my colleague, Diana Lynn, a fellow financial planner and certified financial planner at Advisor Investments.
Hey, Andrew, thanks for having me.
Absolutely. So, the reason we're here today is to talk about the fact that on March 27th, the federal government passed this CARES Act, right? The
Right.
Coronavirus Aid, Relief, and Economic Security Act. This is a big deal because the government basically said we're going to have this package of over $1 trillion that we're stimulating the economy with to try to dull the economic blow that this virus has and will continue to have on the economy, both for individuals and companies. So, this is a big deal. And today we want to give you, the listeners, just a broad overview of what changes to be aware of in this
hmm
bill, especially as they might relate to your financial plan. So, you can see this is timely and important. So we want to split this podcast up into two parts. First, we'll give you a broad overview of just what has changed and what the government decided to do to help out individuals and businesses. And then in the second part, we'll talk about some planning strategies and action items that you might want to think about as it relates to these changes, because not all of the changes may affect you, and some may have a bigger impact than others.
Right.
Um,
Or you may not be aware that there is something that you can take advantage of as part of
yep.
this CARES Act. So, yeah, I think this is a good plan.
Exactly. Any other thoughts before we dive into part one, just what's changed?
No, I like it. Let's dive in.
All right, let's do it. So, broadly, really, there are five categories to think about when looking at what the government intended to change here.
hmm
So, there are the direct payments to taxpayers. That's probably the most visible and
Right.
gotten the
And
most
probably
attention.
affecting the most people as well, I'd say.
Yep, exactly. So we'll get into that. There's also required minimum distributions, RMDs, being waived in 2020. That's been a very high profile item as well. There are also some new changes around COVID related withdrawals from retirement accounts. And of course, small business relief. That's been a big part of this bill as well. And the government also beefed up unemployment benefits and sort of other ancillary benefits like Medicare, student loan relief, things like that. So sort of smaller tweaks around the edges, but those are sort of the big categories.
hmm
All right, Diana. So take us through that first one there, direct payments to taxpayers. How exactly is that going to work?
Sure, the direct payment to taxpayers, this is affecting the majority of Americans today, and it's already beginning to roll out. So,
Hmm.
Congress has authorized one time payments of up to $1,200 per individual taxpayer. So, if you filed your taxes last year, you're as a single file taxpayer, and you have an AGI of up to $75,000, you're going to receive a check of $1,200. It'll be paid to you however you paid your taxes last year. So if you had
Hmm.
direct deposit, they're going to use that banking information to just directly pay you back that $1,200. In addition to that, you'll also receive a $500 payment for each qualifying dependent child. So when you filed your
Hmm.
taxes last year, if you had a dependent child up to the age of 17, you're going to receive $500 per child. That payment will be increased up to $2,400 if you filed as a married filing jointly couple with an
Hmm.
AGI up to 150,000. So, and of course, those stimulus payments are going to be reduced if you are above that threshold. So
Hmm.
the $1,200 or the $2,400 payment will be reduced by $50 per $1,000 of AGI. You are above that limit. But this is not going to affect the payment of the $500 per qualifying dependent child. So, if you are a single filing taxpayer with an AGI income at around 99,000, that's where you've really pretty much phased out of receiving any of this benefit back, but
Hmm.
you will still receive that $500 per child.
Right. So that's a good thing to keep in mind. And remember too that the IRS is basing this on your most recent tax return. So if you haven't filed your 2019 taxes yet, they'll be basing this on your 2018 filing, right? So just something to keep in mind there. And of course, the tax deadline has been extended to July 15th. So if you haven't filed your taxes yet, you have extra time to do that. Another
Correct.
thing to keep in mind too, you mentioned the direct deposit.
Hmm.
I think just a good housekeeping item for listeners is to just go to irs.gov and just make sure that they have your direct deposit information on file if you believe that you're eligible to get a payment. And actually, their
Right.
tool will tell you if you're eligible to get a payment.
Right.
Um, so,
And
so I,
don't panic if they don't
right,
have your direct deposit
right,
information, they'll send you a check. So
yep,
if you are entitled to any portion of the stimulus payment, the government will be sure that you receive it.
right, exactly. And so again, this is a very this item has received a lot of attention, and rightfully so. You want to make sure you get that money that's owed to you if you're eligible. But thanks for
Hmm.
taking us through that one. So, and
Yeah.
then another change that's received a lot of attention is the provision here that's going to waive all required minimum distributions for 2020. So this is a major change, right?
This is huge. I think this
Yeah.
is must be also probably the one of the most beneficial ones. So if
Mm,
you are, over that in 2019, that magical age of 70 and a half, where you
hmm
had to start withdrawing out of your retirement accounts and you're required to take out a minimum amount each year. This is being waived for 2020, which is
hmm
huge because as this markets have been so volatile during this time of the coronavirus, if your portfolio has taken a bit of a hit in this down market, having to withdraw money from that, it's kind of, adding extra salt into the wounds. So
Right.
being able to waive that and say, I'm not going to take out my payment right now, is a huge relief. So if you don't need that money, it's best to just let it be for this year.
Yeah, absolutely. Let it continue to grow tax deferred.
Hmm.
And also, it's money that, when you take out your RMD, of course, you're taxed on that money. So, sort of a win there all around. And remember, this waiver applies to a broad range of retirement accounts, right? We're talking
Hmm.
about traditional IRAs, SEP IRAs, simples, inherited IRAs too. We've gotten questions about that. So
Right.
if you have an inherited IRA, you don't need to take that RMD. So just keep that in mind there. And we have details on our website that we can link in the show notes to get a little bit more into the weeds there for folks.
Okay.
Now, another question around this topic is what if you already took your RMD? Because we've gotten a lot of questions about that from clients.
We've gotten a lot of questions about this from clients, especially some clients that take a little bit of their required minimum distribution each month,
Mm,
or at the first thing in the beginning of the year took out their full required amount for 2020, and now this, oh no, I didn't have to take it out. Can I put it back?
yeah.
And in the short, the answer is yes, you can. So you are eligible to do a 60-day rollover one time a year. So if in the past 365 days you have not done a rollover, you are able to take this distribution that you have taken out and put it back into your IRA. So what I
hmm
mean by if you've already taken a rollover in the past 365 days, if you've recently retired and you took your employer's plan sponsored retirement plan, the 401k, or something similar, and rolled that into your IRA in the past 365 days, unfortunately, you would not be able to put the money back if you took out some of that required minimum distribution. But
hmm
if you haven't and you took any money out of your IRA between the time frame of February 1st, also into the future of May 15th, you can put that money back, just
Okay.
one payment of it. So if you are one of these clients that takes a little bit out each month and uses that to help offset the bills and expenses, you're only able, unfortunately, to put one of those distributions back.
Right. And if you're eligible to do it, to put it back into your IRA, would recommend it. Just because, again,
Oh, absolutely.
right, it allows the money to continue to grow for another year tax deferred, and it's less income tax for you to have to pay
Exactly.
this year. And the IRS also issued a notice just last week that lets anyone who took an RMD between February 1st and May 15th to put the money back by July 15th. Again, if you're eligible. So really,
Right.
it sort of extended that 60-day rollover deadline in a
Hmm.
way, is how I'm understanding it. Is that right?
Yeah, no, I think you hit the nail right on the head. So if you are falling into this category and this is something that interests you, you don't need the money, you're curious about how to put it back, please reach out to your advisor or your financial planner, and they will certainly, work with your unique situation to make sure this is taken care of correctly.
Right. And I know we mentioned inherited IRAs before where you don't need to take the RMD there. Unfortunately, if you already took your RMD from an inherited IRA, you are not eligible to put that money back into the account, even if it's
Yeah,
within that 60-day rollover. So that did not make the cut for the bill.
right.
The only exception there is if you're a spouse, if you're the beneficiary of a spousal inherited IRA, then you would be able to roll that into your own retirement account.
Right. So
Um,
only if the money, if you are the beneficiary of your spouse passed away and you roll that over into your own personal IRA rather
right,
than setting it up and establishing it as an inherited IRA, that's the only way that you would be able to put the money back. Yep, correct.
right. So, sort of in this same vein, talking about a third big change is a relief provision around allowing taxpayers to tap into your retirement account
Hmm.
without penalty.
Right.
So, this could be helpful for folks who have been hit hard by this virus, and
Oh,
let's face it,
sure.
who hasn't been?
Right, sure. So if you, unfortunately maybe have been laid off or furloughed due to the stay-at-home orders in place, if you
Hmm.
are in a pinch and you need to tap into your retirement accounts before you've hit that, age of 59 and a half, you can do so, and you will not be required to pay the 10% penalty. You
Hmm.
will, of course, you have to pay taxes, but another nice caveat that they put into the CARES Act is that you can spread those tax payments out over the course of the next 3 years. So if you
Right.
have to pull out of your portfolio, which you're allowed to do up to $100,000, you don't have to take that huge tax burden this year while you're also, not having any income.
Right. So, and there's a whole list of events that qualify you for this type of
Hmm.
distribution. We won't get into that here, but if you believe you've been affected economically, or your spouse was affected by the COVID-19 crisis here, definitely reach out to your advisor, your CPA.
Right,
But that's important to talk about. I would also just throw in, if you don't need to tap into that account, would recommend not. It's still,
right.
I still see it as a sort of a last resort, just because that is your kind of nest egg. You want to leave that to continue to grow, but it is there if you need it, which is a
Right.
nice little provision that they threw in.
So again, talk to your financial planner or your advisor to really kind of, evaluate all of your options before dipping into that retirement account because those assets we really want to save for when that time comes for when you retire.
Yep, absolutely. So, all right, good. So, again, just to recap what we've talked about so far, we've talked about the stimulus checks, and
Hmm.
we've talked about provisions around RMDs and coronavirus related withdrawals. So, those are three big changes that we've taken you through.
Yep.
Another one that let's focus on now, sort of shifting gears, is the provisions around small business relief.
Yeah.
Now, really, Diana, a lot of this is being hammered out as we go. I
Hmm.
think there's news about this sort of every day, but broadly, what was the aim here? What was the vision of the government as you see it?
Yeah, I think you're right. I mean, this is still continuing to evolve as the small businesses are really the heart of America, right? So
Mm,
anyone that owns, you own a hair salon or a small grocery store, you have your own personal training business and you're
hmm.
unable to, keep running as everyone is social distancing and not shopping in your brick or mortar stores. The government is really trying to help keep these businesses afloat during this time until we are able to go back to life, as it was before. So, if you do
Right.
own a small business that has been impacted by the virus with less than 500 employees, you are able to take out a loan of up to $10 million. Now,
Hmm.
these loans are, of course, first come, first serve. So, there's this kind of a catch 22 where you want to, if
Hmm.
you are a small business owner, hurry up. I want to try to apply for this loan because I want to be sure I'm entitled to some of the funds that are out there, part of that pool. But on the downside of that is, as things are still being ironed out, if you are one of those that have already already taken the benefit up front, and later down the road, there's a benefit that maybe suits you a little better. If you've already applied, you aren't unable to apply for something later down the road. Also, I think some of the banks aren't quite up to speed yet with,
Right.
exactly what these rules are. We're all kind of in this unknown of,
Hmm.
what exactly are the parameters we're working with here. So as a small business owner, even if you were to go to a bank right now, and try to apply for the loan, there you might run into a little bit of red tape, so to speak.
Yeah, absolutely. So, and the other part of this too is that the loan is eligible to be forgiven up to
Hmm.
10 million. Now, the basically the language that we've been given here is that the borrower, you need to certify that the funds will be used to retain workers, maintain
Right.
payroll, make mortgage, lease, or utility payments. Um, and in order
Right.
to be granted that forgiveness, you need to require documentation of payroll and business costs there. So it's really still being figured out as we go, it seems like. But I guess my recommendation for this is, if you believe you're eligible,
Hmm.
speak with your lender, speak with your bank to see if they're eligible to take part in the SBA
Hmm.
loan program, Small Business Association. And obviously speak with your advisor. Will help you think through this, because I think, like you said, Diana, there's going to be some red tape to fight through here.
Yeah. But I think this is an important one, so we can
Yes,
continue to update. Maybe we can add links to this podcast with updates as they become available.
absolutely. Yeah, I know we're writing a bit more about this topic specifically, so look out for that. So good. Thanks for clearing that one up for us. And really, before we move into part two, just to cover some ancillary benefits that the government put into this bill, they included improvements to unemployment benefits, right?
Right. Yeah, the government is really trying to lessen the blow of this hardship to Americans. So, if you are one of the millions of people that have been laid off or furloughed during this time period and are filing for unemployment, they are making some adjustments. So, they're going to be
Hmm.
increasing your employment compensation by $600 per week for 4 months. So, that's a nice extra bump. And then also eliminating that 1 week waiting period. So, typically, when you file for unemployment, there's a 1 week waiting period before you start to receive benefits.
Hmm.
That is going to be kind of thrown by the wayside for now. So if you file and you're eligible, there's no waiting period, and then you're going to see a nice little bump up of $600 per week.
Okay, good. So you can really see, as a listener here, the government took a very broad scope and said, how can we, support individuals and families through this very difficult time? And we
Yeah,
touched on here again those unemployment benefits. We talked about small business relief, as well as waiving RMD provisions, coronavirus related distributions, as well as stimulus checks to individuals and
right.
families. So there's other things here that we covered in our CARES Act blog post that we'll link in the show notes, that talks about a little bit more about some Medicare provisions that were included, as well as student loan relief and changes around charitable contributions. And we'll talk a little bit more about those charitable contribution changes actually in part two here, which will move into sort of what actions should you be
Yeah.
taking, if any,
So,
right?
Andrew, what are
Because
you
yeah.
seeing as a financial planner working with clients? With all of these different provisions in the CARE Act, what are the main actions that you're seeing clients take here?
So what I'm seeing is an opportunity potentially for some tax planning here,
Yeah.
because so if you're someone, you didn't have to take your required minimum distribution this year, that
Hmm.
means that you could potentially be in a lower income tax bracket than you were last year. In years where you are in a low tax bracket, those are opportunities to take advantage of. So how do you take advantage of something like that?
Yeah,
Well, you could do potentially a Roth conversion, right? So if
I
that's
like
if
that.
that's a fit for you, right? So this is where you would take money from your traditional IRA, move it over into your Roth bucket, pay taxes on it, but
Right.
then once it's in your Roth, you never have to pay taxes again. So again,
Or
why
take
would
a
you?
required minimum distribution. So you're
Sure.
kind of elongating that ability of not taking required minimum distributions if you make that Roth conversion now, right?
Yep, exactly. So you're kind of thinning out that IRA for down the road. potentially lessening the RMDs that you would need to take in future years. So again, the opportunity there is because if you're in a lower income tax bracket than you usually find yourself in, you might have more room in your tax bracket to move over some of that money. And typically, when the market isn't performing very well, which it,
Hmm.
obviously we've had a lot of volatility recently. Um, there, the opportunity to do Roth conversions is even greater. So there's sort of a double benefit there to doing that. So again, if you are someone who's in a lower income tax bracket this year, talk to your financial planner, your financial advisor, and we would be happy to drop some illustrations for you to show you how you might benefit from doing something like this.
Right. No, I like that. Now, what if I am someone that I use a portion of my required minimum distributions for qualified charitable donations, for
Mm.
QCDs? Is there any, changes to planning that I should be thinking about here?
Right. That's a common question that we receive from clients too, because RMDs don't need to be taken this year, so can you
Hmm.
still do a
Right.
QCD? And the answer is yes. So as long as you are at least 70 and a half, you are still eligible to make a qualified charitable distribution. It's still a great strategy to take advantage of if you are already charitably inclined and you'd like to sort of use your pre-tax money to achieve your charitable goals. And again, it's potentially a way to thin out your traditional IRA or account that you need to take a RMD from in future years, potentially lowering that for future years. So it's still a viable strategy. I think it
Yeah.
depends from person to person, but kind of broadly too on the charitable front, there the typical provision has been you are only eligible to make contributions up to 60% of your
I
AGI
was just going
to
to
a
ask you
public
about
charity,
this. You read
right?
my
Right.
mind.
Yeah, there you go. So that 60% has been thrown out the window for 2020, and you can actually contribute up to 100% of your
It's
AGI.
huge.
Yeah, I mean that could be a big opportunity for some folks up there. Again, for cash contributions to a
Right.
qualifying charity. So that's something to keep in mind too. So there's some changes around charitable contributions to keep in mind here.
I like it. Now,
Yeah.
are there any strategies for a small business owner that you want to mention here?
Well, I think again, since this is one that's really evolving, I think the takeaway here: contact the planning team. We'll
Yeah.
help you think this through, depending on what your individual situation is. Who your lender is, just what your network looks like, because that's gonna vary depending on what your if your bank is even prepared to
Hmm.
take applications, right? Because there's going to be a huge demand for this as the ramifications economically of this virus starts to spread. Um, so this is a tough one, but I think just contact us, contact your advisor. We'll help you think this one through.
Hmm.
And another one not to miss, and again, we didn't spend too much time on this, but the tax filing deadline was extended to July 15th. So what
Right.
also does that mean, right? It means you can contribute to retirement accounts until July 15th.
Right. Yep,
Um,
that's huge. So if you haven't made that contribution to your IRA account yet, you still have a couple months left here to make that 2019 contribution.
Exactly. Yeah, that's right. I should have said that. So this is contributions for 2019. So it's a nice little bridge if you haven't done that yet. Um, Nice extension there to get some
Hmm.
more money into your retirement accounts. So this has been a lot to take in, and
Yeah.
there's probably going to be more legislative action to come. Again, because we're still in the beginning of just seeing what the impact of this virus will be on the economy domestically and globally. And we'll continue to provide our insights, as well as just the intricacies and the impacts of these legislative measures as they become clearer.
Right.
Um, if you have any questions, regarding how this CARES Act may impact you or someone please contact us. Contact your portfolio executive. We're here to help you.
Absolutely.
Any other big takeaways for you, Diana?
Well, I agree with you. This is a lot to take in, and we
Right.
are in certainly unprecedented times. I think this might also be a wonderful time if you have already gone through the financial planning process. This is a
Mhm.
wonderful time to bring it up, take a peek and see how, the market volatility or these different provisions in the CARE Act are affecting you personally. If you
Mhm.
don't have a financial plan, this is also a wonderful time to get started, a way to monitor your expenses and your income, kind of laying that foundation work and seeing, diving into the weeds to see if there are any of these benefits the government is putting out that you can take advantage of.
Yeah, I think that's a great point. Just to talk about when we were talking about action items that you could potentially take, say, taking advantage of a low income tax year, that's going to become a
Hmm.
lot clearer if you have a financial plan to see if it's something that you can or should take advantage of, because a lot of these decisions are really difficult to make without that broader context of where
Right.
you are today, and where your plan is headed over time. So that's a great point. I think this is just a great time to sit down with your financial planner or advisor, and really just go through the exercise. If you've already done it, 1 or 2 years ago, now is the time to update it.
Right.
When there's a
Absolutely.
big event like this, this is a great time to just sort of level set and have the conversation again, just to make sure that everything is updated.
Right. And like you said, we're here for you. So
Mhm.
we are going to continue to stay up to date on all of the um, modifications that are made to this CARE Act or improvements. And we're here. So please ask us questions.
Absolutely. Well, Diana, this has been a great conversation about a very difficult topic, but I'm glad that we took the time to do it. And I think it's really going to be worth, hopefully, the listening that you did here. If you did enjoy this conversation, please subscribe, review our show, and you can always check us out at advisorinvestments.com/podcasts. So your feedback is always welcome. And if you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Thanks, as always, for listening.